Everybody knows Cliff, right? So,
Yes.
long-term friend, supporter of Upstart. One of the best attorneys in town, hands down. If you're ever raising money, this is the first person you should talk to. But he's going to talk a little bit today about safes in general, which is an incredibly useful tool. That being said, Cliff, take it away with it.
Sounds good. Thank you, Ben. I think I know everybody here. As you guys know, I'm with Holland & Knight, 2,200 plus attorney law firm with 35 offices. Happy to be here. Obviously, I focus on startups, do a lot of safe financings. And I did want to make one note of which Ben has already corrected. Originally, this said how to crack a safe note, just so we're all aware. That may be a thing Ben uses, but everybody else just refer to it as a safe. It's a simple agreement for future equity. That's what we're talking about. You will see people who refer to it as a safe note, and there are people out on the internet and everything using it like that, but really just refer to it as a safe. I actually... It's what?
Is it a red flag?
It's just an annoyance for people who just use it as a safe. Like literally, I had documents that I prepared for a presentation I'm doing in June. This evening, and somebody had edited my document to say safe note, and then I sent it to the guys answering the questions, and they're like, you said safe noted, right? And I didn't even catch it, but it was annoying to them. Before jumping into what a safe is, I just wanted to cover a little securities law 101, because frankly, it's super simple for somebody to grab a safe off the internet and to go start selling it. But the issue is it's a security. And whenever you're selling securities, you need to understand and comply with securities laws. Generally speaking, there's two layers of securities laws. One, federal securities laws, and two, state level securities laws. Generally, things are easy to comply with at the federal level, but then if you're looking at states, you literally need to look at the individual laws of every state that you sell into. So if you are doing an offering to people in Oregon, Washington, and California, you need to comply with the state securities laws of Oregon, Washington, and California. Generally speaking, what is a security, right? The Supreme Court, in a case involving Florida fruit parcels, kind of made this test, which is security is something that involves an investment of money and a common enterprise, an expectation of profit through the management and control of others. So if you think about a safe, for example, right? An investor invests in a safe, he's expecting whoever sold that safe to him to create value in this company. And it doesn't really have anything to do with the investor other than the investor made the investment. And so again, like a safe is an investment of money in a common enterprise, which is the company. That investor expects profit, and that company is being controlled by others. So this, just like a note, just like shares of a company, debt, anything you sell to investors is a security. So you need to comply with securities laws. Oregon securities laws themselves expand liability to other people. Unlike any other state in the country, it expands liability to others. So if somebody asks you to help them go raise money, you should be thinking about that, because there's an Oregon Supreme Court case that basically held that a lawyer who helped the companies prepare documents, not even with the offering, that the lawyer prepared documents so a company could go out and raise money with them. The company founder took those documents, raised money, didn't even tell the lawyer what they were doing. Just kind of went on their own way. But the lawyer was still held liable, which frankly doesn't seem fair to any securities lawyer that I've ever spoken to, but that's the law that we deal with here in Oregon. So until that's changed, which would require a congressional act, that's where we stand. And
whenever you say raising money in Oregon, is that an Oregon-based company? Is that Oregon investors? What qualifies as raising in Oregon?
So anytime you're raising money from an Oregon investor, and if it's an Oregon company, if like the Oregon securities laws is going to apply as long as there is what they call nexus, as long as there's a connection to Oregon.
Right? They legally live in Oregon? Or like what if the investor lives in Portland, but legally they live in Vegas or something? Like, Oregon?
So you may when you're looking at investment agreements, you'll always see, there's actually something I think I've added to the safe, but a representation saying my principal place of residence is at the address under the signature line, right? So they're attesting to what laws applies. And that's exactly why that rep is in there. Or if it's a company making the rep, the principal place of business is that address. So those are the securities laws that we need to look at.
So an Oregon company that only has investors outside of Oregon?
Investors Council is always going to look at the most favorable laws. So they're going to say, this is an Oregon company. They were selling out of Oregon. There's a nexus connection to Oregon. They're going to apply Oregon laws. Yeah. One of the funds I represent was just asked by a portfolio company if they could use by an Oregon portfolio company, if they could use their investment summary write-up to help market the company. I said, if you're in any other state in this country, I would say that's fine. But in Oregon, they're going to think that or some securities lawyer is going to come and say you materially aided in the sale of that securities for that company just by providing your data, because it would have been relied upon in the sale, right? Anyway, yeah, that's case is called Prince v. Bryden. Just when damages, generally speaking, if you violate securities laws, anybody involved would be responsible for return of the money plus 9%. Plus this third one, which is probably the biggest. If you're a startup guy and you're going to be wanting to raise more money, you're going to be considered what they call a bad boy. And you're not going to be able to rely on some of the most commonly used exemptions. You wouldn't be able to sit on the board or be an officer of a company that would go out and raise money and use one of these exemptions. So that can be right down here, the ability to rely on 506. And just to put that in context, over 90% of financings in the US, at least according to the SEC studies, rely on Rule 506. Okay, let's get into it. What is a safe? It's a simple agreement for future equity. Break that down. It was originally produced by the accelerator Y Combinator, right? For use by their portfolio companies to raise money. Very similar to a convertible note, but it's not, right? Is it debt or equity? No. It's this quasi instrument, even like for balance sheet purposes. Accountants don't know where to put it because, again, it's not debt. There's never an obligation. There's not an current obligation to pay it at any one time. There's no interest. But when you do, but again, it's still a security. When you do go about selling a safe, the safe itself is a very simple instrument. So oftentimes you'll have investors that'll come in and say, it's too simple. I want some more rights. So there's a very standard pro rata side letter that was produced by Y Combinator. So do people know what pro rata rights are? Ever heard of participation rights? Okay. So what that is, participation pro rata is the exact same thing. It's basically the right to participate in future rounds. When the company goes to do the actual financing where the safe will convert into shares, at that point, this investor who owns a safe, if they have a pro rata side letter, would be able to participate in the round and invest additional cash. It would give them the right.
Why do they want to do that?
So if they think the company is really going places, they'd want to double down. So obviously, if it's getting to a stage where it's doing an equity round, there's other investors who believe in the company, so it's got some momentum. Yeah, again, it's just all about doubling down. So that's the one side letter that the pro rata side letter is the one that most often would accompany a safe if somebody wants it. Also, I've seen investors wanting things like a board observer right or certain information rights. And all of that stuff is negotiable, keep in mind, as well as the time period in which you provide those rights. It's all negotiable. So I say that along with my whole spiel on securities laws to say, although it's such a simple instrument, oftentimes you get into some complexities where it's really good to have an attorney have your back. where they can be there just to guide you and advise you on maybe the site letter is reasonable, but we need to tweak it X, Y, Z. Or your securities laws, we need to figure out really what we're doing here so you can comply. By the way, on securities laws, going back, friends and family, for those people who think about friends and family round, misnomer, there's really not such a thing. Really, when you're going out to raise money, you're really going to want to raise everything from accredited investors. Keeps everything simple. It's far easier to comply with the securities laws. Sorry.
Yeah, I assume there's a continuum, so it's a simple agreement for future equity.
Yep.
There's a complicated agreement for future equity. Like, at what point do you stop using the safe with the side letters?
So the whole idea is that you would sell essentially the exact same form of the safe to all your investors in that round. And I'll get into when we'll use it. But again, generally speaking, you're going to want to have all of your investors on that safe on the same terms. And we'll get into some terms in a later slide. Didn't ask your question. Okay. So the question, when can it be used? Like convertible notes, safes are intended to be bridge financing, meaning a bridge to an equity financing, a precursor to an equity financing. The whole idea is if you're raising money on a safe or a convertible note, you will do an equity financing in the future, because that is generally the way that an investor will convert that safe into shares. So you're not just holding onto the safe to hold it. They actually want to have shares. So when can we do that? Generally when a company's just starting out. Very commonly used to use a safe. Similarly, if a company is in between financings, it's a super easy instrument. When I say in between financing, in between round, let's say they raised 5 million and they're getting toward the end of their runway, but they're getting close to raising their next round. They may go out and sell a small safe round just to fill that gap, knowing that it will convert in this next equity round. That make sense so far?
It's okay.
Good.
Keep going. It was just a extra.
Okay. So why is safe? Safe is generally considered very company friendly. Again, it's not debt. There's no ticking time bomb. There's no interest, no maturity date. If you compare that to a convertible note, right? Convertible note carries interest and it has a maturity date. So the company's always under the gun to do an equity financing because they want to stop the accrual of interest, because the more interest that accrues, the more shares that it will convert into. Similarly, they want that to convert before the actual maturity date. And so there's always that pressure. With the safe, it literally just sits there until there's an equity financing and investors can't push you.
Quick context on that, why safes are like always better than convertible notes, in my opinion. Like I've gotten flopped on convertible notes twice. Once was, A, it's debt on your balance sheet. So anytime you go to a bank and you're like, hey, we're getting a little bigger, we're like a real thing now. Can I get a $30,000 line of credit? They're going to immediately look at your balance sheet and see $1 million of debt. Even though it's debt, but it's still a convertible note that's going to become equity. They don't care it's debt. Mm-hmm. So they won't give you much financing. Second, when I had my co-working company, barely survived the pandemic, came to an agreement with my early investors on our convertible note. We're like, look, we're just going to sell it. You're going to get 75 cents on the dollar back, which they were fine with. But that 25% delta was forgiven debt, which I was taxed on. So it's like a very hard time when the IRS comes calling and says, oh, you owe $50K. And it's, wait, what? No, because that's forgiven debt. Very, very different than a safe. And then you talk to the funds who are like, we love a convertible note. It's more secure. It's more secure. That's their best interest. Like they do not have your best interest at heart. I would avoid them at all costs, personally.
Yeah, you brought up a really good point that I see, frankly, some lawyers, some startup lawyers in town poorly advising their clients on. You said you had to recognize some income when you essentially shut the company down and you had this debt on the books for a convertible note. You obviously had an LLC, right? Because with an LLC, it's a flow-through entity. If you sell notes in an LLC, that will, show up as debt. If you end up having to shut the doors before the debt converts, you have to recognize it because it's considered forgiveness of debt income. If it was a corporation, that wouldn't happen. Another reason that startups should always be corporations, and always tell people if you do have an LLC, don't raise money on convertible debt.
What if an LLC is taxed as an S corp? Is that different?
You're going to have other problems. It's still a flow through entity, actually. So you're still going to have that. But keep in mind that convertible debt usually would convert into preferred stock. With S corps, you can only have one class of stock. So it creates other problems. So generally speaking, and investors are not going to oftentimes want to invest in S corps for multiple reasons.
What kind of corp would it be?
C corp.
C corp.
There. Again, the document is standardized. Really, there's very little negotiation of the document itself. I have a couple small changes I make to the safe to include some securities notices for certain states, but otherwise stick to the form of it. Investors, I will say in general, are pretty lazy. They want to see something that they've seen before. So you show them a Y Combinator safe that hasn't been changed, they're going to look at it in general and say, oh yeah, that's what we're used to. That's what we're ready for. Again, minimal cost, because what we're doing is we're taking a document that's essentially a stock document. Where we get into legal costs is just walking through and helping you work with investors, right? But otherwise, the document itself, you have a board consent and then a safe that's already there, prepared. One thing that a safe does, just a convertible note, is you get to kick the can on valuation. You don't have to set a valuation, so it's nice for startup companies because we just get to kick the can. We don't have to negotiate that. Really, the only thing you're going to negotiate, generally speaking, is a discount and or a cap.
What happens if you aren't able to raise money or you don't raise money in that situation?
Well, then, but the company continues.
Yeah.
So literally, it still just sits there. It just sits there. And if, generally speaking, a company that doesn't go out and raise money, they're going to go out of business, or it's going to be a sale. And we'll get to it. That would be a triggering event that you essentially get paid or you would convert. Okay. Oh, the safes, I will tell you, in the Pacific Northwest, really Oregon, Portland, investors didn't really like them, but they're getting used more and more. Definitely down in California, it's used all the time. Seattle, it's used all the time. Some investors in Portland just haven't really come around, although they're coming around more and more. To that point, why don't some investors like safe? Again, to this ticking time bomb, they have nothing to hold you accountable. They have nothing to say, come on, you need to raise some money. You need to do something with this. It literally can just sit there on the balance sheet. There's no security, right? It's not like debt. It's not secured debt. There's nothing there. There's no control or other investor rights. Again, sometimes they may negotiate a side letter where they get some rights, but generally speaking, there's nothing there. They give you 25, 50, 100,000, and they're literally just sitting there helpless. In terms of representations and warranties, these are statements made by the company to say, yes, this is our capitalization, or yes, we're in good standing. There's very few of them in the safe. And so there's investors, again, are not getting a lot there. That said, a lot of startups aren't going to have a lot there yet to make our presentations do. But this is truly meant to be a simple agreement. There's also uncertainty in terms of how courts would view a safe. For example, if there's a bankruptcy, as we've noted, it's not debt. So if the company actually had assets, how would the safe be viewed in a bankruptcy? We don't really know. And different jurisdictions could be different. Safes are a pretty new instrument. Again, there's some reasons that investors may not like safes that are pretty valid, frankly. Questions? Okay, different types of safes. So there's really...
So why would investors tolerate it then with all that downside? Like just the simplicity of seeing something.
Simplicity, they want to get involved in companies, right? These are angel investors who are making very risky investments. And their real options would be doing a convertible note or a safe with these companies. And again, going back to our points on Oregon and Portland, right? This is some of the reasons that investors here will prefer notes over safes. But when they want to get involved in a hot company, and that's all that the company's offering, and other people have invested on a safe, then investors don't have a lot of negotiating power.
Well, this kind of seems like a silly question that I've asked before. Couldn't they just directly buy equity in the company at this stage?
Some investor comes in and says, I want to make an investment.
I want to like buy 10% of your company.
Absolutely. But then the issue is, okay, what is the valuation that they're investing in? And do you as a founder want to sell at that valuation? The whole idea here is we may be worth $1 million right now, frankly, but in 2 years, we're going to be worth $500,000 investment where it would be 50% of the company now is only 10% when it would convert. So and by the way, the math, 500,000 divided by $1 million.
So it would be preferable for the investor if they would want to come and do that. It's just more complicated than this founder you would want to do that.
Correct. The whole idea is we're kicking the can on that discussion and giving us time to grow. But and to that point, I've seen a lot of CPG, consumer product group companies, try to raise money on convertible notes. They don't have the growth of technology startups. So it's really difficult for them to keep up with even the interest rate oftentimes. And so convertible notes can be a really difficult instrument for CPG companies to raise money on. It's really for tech companies. But the safes, again, don't have that issue. Okay, so again, the safes, it is a simple document, but question is how will it convert? And I'll go through some actual spreadsheet examples of how it does convert. But you've got one type of safe, which is just valuation cap only. So valuation cap, stepping back actually to when safes first came out, Y Combinator came out with a safe. It was a pre-money safe, which means that if you set the cap, then and you raise money on a valuation next to that cap, the money would come in on top of the cap. So more specifically, if you had, let's just say you had a cap of 5 million and somebody made a $100,000 investment, you would take their investment and it would be after the investment, the company would be worth 5.1 million and the pricing of it will be based on essentially 5 million divided by the number of shares currently outstanding. In contrast, what they've gone to is a post-money safe. They're using that example, that 5 million, we're actually going to take the shares that the safe would convert into and use that in the denominator for determining the price per share. So the price per share would be lower. But what does that mean for investors? It means they're given more assurances on what kind of percentage of the company they're going to end up with. Can you follow? So if, let's just say somebody puts $1 million in a post-money safe with $5 million cap, they're going to get 20% of the outstanding shares immediately before the new money comes in. Whereas if it was a pre-money safe, it would be less than 20%. Okay? And I'll go through a spreadsheet that kind of, won't go pre-money, post-money, but we'll cover this. Second one is discount only, which oftentimes you're just providing a 10 or 20% discount on whatever the share price is in the next round. Super simple. Third option is valuation cap and discount. Generally speaking, I think valuation cap and discount is the most common I see. And the fourth one is most favored nation. All that means is basically they will get anytime the company sells a convertible security between the time somebody receives a safe and they do an equity financing, if it is sold on better terms, then the person with the most favored nation safe would have the right to get those terms. Okay. Questions on those? Okay. So in terms of conversion, What are the triggering events? Obviously, most common is an equity financing. Again, this whole idea is we are selling safes to where they will convert in an equity financing, right? The other option is if the company sells. Actually, there's three. Equity sale, sale of the company, and if the company sells, then the safe holder is going to have a priority distribution over existing common stockholders equal to the greater of what they invested or what their safe would convert on if it converted on the terms in the safe. And the third one is just a liquidation of the company, which is frankly, nobody's going to get anything anyway. So while it's a triggering event, there's really nothing happening there. With that, I am going to, Ben, is this going to, so I've got way too many things on my, so what I've done, everybody heard of pro forma financing statements? Right? Pro forma. So what we're trying to do is model what a financing would be with, like, what would the safes convert into? So I've created this fictional company, Acme AI Inc. And we've got Allie with the most shares because she was the founder, Ben, Denise, and Josh, with Josh, of course, getting the least amount of shares. And we've got a typical setup where we've got 4.5 million shares outstanding, an option pool of 500,000 or 10%, just to basically start the company's capitalization. But now what we've done is we've sold $450,000 worth of safes. We've got and these safes, I'm assuming here, are post-money safes with a valuation cap and discount. Yeah. And what I have said is here, we're going to do it with a $5 million post-money cap, discount rate of 80%. Keep in mind, people are always like, wait a minute, I've got a 20% discount because 20% is super common. When we talk about discount rates with safes, it's inverse. So if you're thinking a 20% discount, the discount rate is actually 80%. And that's the way it'd show up in the document. Okay. So going back to this, you never know what it's going to convert into because you have to make a bunch of assumptions. First of all, what's your pre-money valuation going to be? How much money are you going to raise? And what's your post-closing option pool going to be? Right? But then once you know that, here again, we're basing it on a $7 million pre-money valuation, but we've got post-money valuation cap at the safe, $5 million. So how does that convert? So we've got to determine what the price is based on a $5 million post-money valuation cap. So what we do is we take the shares outstanding, 4.5 million, right? 4.5 million. We take the option pool plus, again, because this is a post-money safe, we've got to include the shares into which the safes would convert to give us essentially what they call the capitalization of the company for the safe purposes. You take 5 million divided by that 5.5 million to end up with about 91 cents per share price. So that would be the capped price. And then determining the number of shares based on that cap, I'll literally just take the investment divided by that cap price to come up with the number of shares. With discount, it's literally taking whatever the share price is calculated for the financing and multiplying it times, per share price. So right here, we've got with this round, the investors bringing in new money are going to be paying $1.20. But if these converted at discount, it would convert at 96 cents because it's 20% off of that price. What's the lower of the two? 91 cents, which is the cap price. So here they're all converting into that capped amount.
And were you saying that it's It's common when you're selling a safe that's
Absolutely.
the first one that you sell. It's important.
It's ideal if you do that. Couple words of warning. Yeah, the pre-money and the post-money safes don't play well together. So I always try to avoid that. But I also do have a lot of clients who will come in and say, early money, we want to give them a bigger discount. Or if a company is wanting to raise, it is not ready to raise an equity financing, to go out and raise a couple $1 million, they know they've increased the value of the company. They can go out like a year after they've issued this first round of safes with a higher valuation cap. Generally speaking, it would be the same discount, but a higher valuation cap. I've got a client out of India, was a Y Combinator company, has raised quite a bit and loves to sell safes. And doing the pro forma cap table like this, we've got, I want to say, 5 different safes. And as long as you're using all post-money safes, we can get the spreadsheets to work pretty well. But I always want to avoid any, again, combining pre and post. But to answer your question, you can absolutely use different caps, different discount rates. From a securities perspective, you'd want to be generally pretty consistent in a certain term. You don't want to be saying, hey, an investor, we're selling all these at 20%, $5 million cap. Meanwhile, go out to another investor and sell it at totally different. One, it could piss off your investors, and 2, some securities issues. Ben.
Yeah, how do you figure out, especially if it's your first time, what a good discount or cap would be? Like, do you go out to the market to see what other people are selling at, or look for advice from someone like you? Like, how do I know a 20% discount is a good thing as opposed to a 5 or 40?
Yeah, and a lot of the times, yes, talking to people who've been raising money in currently that are out there, or talking to a lawyer who's helping a bunch of companies raise money. Obviously, we got a lot of that intel. But yeah, and then generally what people can do, 20% is a very standard discount if you're going to go a discount and a cap. Sometimes on the founder side, you don't want to negotiate against yourself. So you may start with a slightly higher cap. But I will share one rule with you, the golden rule, right? Those with the gold make the rules. So if investors aren't buying it and you're going to have to decrease that cap, then you just figure out where that fits. I will tell you, a lot of companies are selling safes and early stage, don't have a product, not generating revenue, and it's generally a cap between 3 and 5 million. A lot of it depends on have the founders raised money in the past. I've got clients who will go out and raise pretty significant amounts of money, don't have anything yet, but the fact that they had 2 or 3 exits in the past, investors didn't care. They just wanted their money in there. So valuation caps were 8, 10 million. And again, there was nothing to support it other than an idea and a founder who had been through multiple exits. Yeah, and one of the things we do with clients is walk them through this, educate people. So you could take a spreadsheet like this and, okay, well, what if it was 8 million or 80 million? Let's say, a little much. But how does that change things? And what this does is you as a founder can look at this and say, okay, Allie, if she owned 50% of the company before the financing, when the safes convert and the new money comes in, if I'm raising $3 million on an 80 million pre, Allie's percentage ownership went from 50% to 31%. So a lot of that's just looking at it. Another piece actually to keep in mind here, we'll see Series C and Series C2. So I've assumed this is going to be a Series C financing. Very common type of early stage equity financing round. But there's 2 different series because we've got, like generally the rights of these 2 different series would be the exact same, but they would have a different liquidation preference. The liquidation preference of the Series C it's going to the new investors is going to be the price they're paying. In this case, it's $1.38. In the case of the safe holders, it'll be 91 cents. Everybody understand liquidation preference? So if a company sells sells, generally holders of preferred stock will be entitled to the greater of their liquidation preference, or with most stock, or what it would convert it into if it converted to common stock. So that price here, like the 91 cents, is their floor before any common holder would receive anything, right? So for founders, we want to keep that liquidation preference as low as possible, right? Because we don't get paid as founders until we've exceeded in a sale that liquidation preference. More lower the liquidation preference, the more the proceeds should exceed it, the more money we all get. So we basically create what they call a shadow series. So this series seed 2, it'd just be what they call a shadow series of the seed 1, with the only difference being that the seed 2 has a lower liquidation preference. Good? Okay. Your triggering events, examples. The only thing, obviously, I have seen founders who I'm not representing sell too many safes. They're like so eager to go out and sell safes, and they'll do it with like $2 million cap or something. All of a sudden they've sold $500,000 worth of safes. That's going to take up a quarter of your capitalization before you've even raised any more money. So 500,000 divided by 2 million, just be aware. Always understand where you are when you're selling safes, and do the exercise of going through and doing a pro forma, how that could convert and how you know what it'll do to your ownership percentage. You just don't want to be surprised.
What standard dealers see? What are the booms of least you've seen sold, and like the most healthy amount you've seen sold in the safe round?
I've definitely seen some higher ones, but companies I wasn't representing. So stories you hear, what were they thinking? Healthy, honestly, is like 10 to 15%. Because again, when you do the equity financing, that's going to be further dilution. Yeah, and it's a really subjective. Can really depends on what the company's doing, how it's raising. But
So that would be like 300,000 on a $3 million.
and keep in mind when you're just starting out, $300,000 for 2 founders trying to get the company going, be a fairly substantial amount.
Yeah, when you're discovering like the amount that you should raise, like outside of any hard costs you're coming into, like I usually hear 18 months of runway. Is that like a good rule of thumb?
Definitely with equity financings,
Yeah.
yes. Yeah. And even with, you should be, everything's market driven, right? It's really difficult to raise money, right? So I'm seeing companies that thought they were going to go out and do an equity raise saying, we don't think we can raise the money right now. So guess what? We're going to do another safe round to just extend that runway. But hopefully the runway at that point is becoming shorter. And to your point, a common maturity date for notes is often 2 years. Why? Because they want to raise money and it's hopefully convert that in right around 18 months. Questions?
Or you see it go off the rails. Like, when is the safe just a terrible?
When is safe a terrible idea? I don't know that you can get in trouble obviously when you're selling too many safes or too much in aggregate dollar. I don't know that when you're not looking to raise additional funding. I've actually had some investors say, or founders say, all we're going to need is 500,000. We're just going to go out and raise it on safe. So if you're an investor, how is it going to resonate with you as an investor if the company is saying, we're going to sell you a safe, but we're never going to do a transaction in which that safe would convert? It's not a great pitch. It doesn't resonate. The founder doesn't understand what they're doing. So probably the worst time to do it. You need to have some idea that, yes, I'm going to go out and continue to raise money.
I have a question on, you had the comment about only selling to accredited investors. And from my knowledge of this, based on a few criteria around like your net assets and your like, once you're an accredited investor, are you always an accredited investor?
So accredited investor status can vary. It's always as of the moment you're making the investment, right? Depending on what you're doing, it always depends. I know it's the lawyer answer. Generally speaking, if you're just doing a Rule 506 offering and you're not doing general solicitations, you're not putting your offering on a billboard, you're not putting out press releases saying, hey, I'm raising money. You're not going to, you'll see people are going to BVC. You'll see some people say, we're raising this, just making a general announcement. People who are advised should know to say, or not say they're raising money. Everybody who's watching them should know that they're likely looking for money, but they shouldn't be saying it because there's a bunch of, we know, people who are not accredited out there. So accredited status, first of all, for individuals, your income is 200,000 for the last 2 years, 300,000 with your spouse for the last 2 years, reasonable expectation of it this year. Your net worth is $1 million excluding your primary resident. And then if you are a company, generally speaking, all of the owners of that company need to be accredited or has over $5 million in assets. So you're going to accept money from an LLC. All of its LLC members have to be accredited, or it has to have $5 million in assets. How do you verify it? Which was your other question. We have investor questionnaires. They can basically provide them, and it's literally a check the box. They check it and certify it, and then the safe, as well as any other instrument we have, is going to include representations that they are stating that they are an accredited investor.
Is your liability if they lie about it?
Only if you didn't have a good faith belief. So if they lie about it and we know that the person, there's no way, then you're liable, right? And the other piece to that is keep in mind that most of the securities exemptions, what we're relying on to sell the securities, means that everybody's an accredited investor. So what happens if there's one not unaccredited investor? It can screw up the entire offering. It can basically mean every single investor could be entitled to damages and rescission of the offering. So it's a real spoiler. So yeah, but it's essentially good faith belief. There's also there's a 506c offering where you can do general solicitation. You can go out and tell the world, I'm raising money. There you actually have to have verification, and which would mean literally looking at bank statements or investment statements and running a credit report. Or simplest approach, those people is just have their investors send a letter to the company saying, yes, this is my client and they're an accredited investor. Then you can rely on that.
So is it a good rule of thumb that in general is, I had been told that about that venture conference, but in general, anytime you're doing a pitch for an audience, to not say we're raising $9.
Correct. Step back. If you were at Elevate, like an Elevate investor event, right, and it's just you're speaking to the investors,
Okay.
you could absolutely tell them everything. But at BVC, where there's a bunch of people who are not accredited, you really want to be careful about it. Practically speaking, I've never heard of anyone getting in trouble for it, but the securities regulators always, they say you just can't go out and make public statements about offerings. Frankly, I had a client fairly recently who put out a big press release about the offering before it was done. So had some interesting discussions with that client. And yeah, I was following an email that I forwarded to him, highlighting where I told him not to do that. But yes.
Another question on convertible notes. How is the interest rate on that determined? Is that
Negotiated.
just negotiated because it's out in the market at all?
People always come back to that.
Yeah.
But when somebody invests in a convertible note, they're not investing in debt.
Yeah.
They're not. Nobody expects to be paid back on the debt. They expect it to convert.
Gotcha.
So when investors bring that up, like you obviously don't make many investments. 8% is a standard rate. It really is. You'll get some companies that are hard up for money. I've got one, they just did a note with a 16% interest rate for $10 million. But it's a very profitable company, despite that needing some money for growth. But anyway, yeah. Any other questions?
Oh,
Good.
Appreciate it, Cliff.
Thanks, Glenn.
Okay, guys. Thank you.